Hi, this is Ken Align with My Home Option, and today we are going to be talking about how do you as a homeowner access your home's credit. We're going to be looking at home equity loans, home equity line of credits, and cash out refinances to be specific. We're going to help you answer the question of, do I as a homeowner qualify for one of these options? And we're going to look at some of the similarities and the differences between these different options. So let's get right to the video. So before we look at all the different options that you have before you of these different loan types, it's really important to understand whether you're even going to be able to qualify and use one of these loans. And one of the biggest ways that you can check that out first and foremost, without even talking about income or credit or any of that kind of stuff, is figuring out what is your home's equity position. Now, this is basically the way you calculate this is you take what is the value of your home, you subtract away how much you still owe on it, whether it's your mortgage, your note, whatever you call it. The difference between those two is going to be your equity. So let's say that your home is valued at $200,000. Let's say you still owe $160,000. Then your equity position is $40,000. You have 20% of equity, or you're at an 80% loan to value, depending on how you want to word that. Now, for most of these loans, you're going to have at a minimum, absolute minimum, 85% loan to value to even qualify and be able to use one of these options for all of them. That's what you're gonna have to be sitting at, because at the end of the day, at a minimum, they want you to be at 90% loan to value when everything's said and done, and there's some costs that are gonna be rolled into it. So make sure you do that right quick. Check out your value, check out your note, and make sure that you have at least 85% LTV. Anything greater than that is awesome. You might have 80% or 70%. The lower that ratio is, that means the more equity that you have. So the greater the difference between your home's value and obviously what you still owe, that's going to be your equity position. The more equity that you have, the better off you're going to be with these different options. So now let's get into the different options that we have before us and break them down. We're going to be talking about the home equity loan. We're going to be talking about a home equity line of credit, and we're going to be talking about a cash out refinance. So let's talk about a home equity loan first. This is going to typically be at closing, you're going to get one large lump sum that you're going to have to pay back. Now, this one large lump sum could be $40,000 immediately given to you. You're allowed to do whatever you want. It's at your discretion how you spend it, what you do with it. Now, it is recommended on all these different options that you really put your equity back into debt consolidation or home improvements that drive up the value of your property, but it is yours at the end of the day to do what you want with. One lump sum. You can get these with a fixed interest rate. Typically, this is going to be a second note or a second mortgage. So you'll still have your original mortgage, and then you'll get a home equity loan on top of, or actually it'll be underneath. It'll be a second position lien, but it'll be at the same time as your original note. So then you'll be paying both of those. So one of the biggest ways that we see this used is for debt consolidation. So you might take car payments, credit card payments, all that kind of stuff, student loans, maybe all that kind of stuff, consolidate it into one large lump sum that may be actually a lower interest rate on a home equity loan. You can roll that all into that type of loan. That's one great way to use it. And then typically the repayment, the term on a note like this is going to be about 15 years. The next option that we have that we're going to look at is the home equity line of credit. So in this option, you're still getting, that amount. It's still going to be a secondary note most of the time, but you borrow what you need as you need it. And the biggest difference is that you don't get everything at one time. The biggest difference between a home equity loan and a home equity line of credit is you don't get everything at one time like you do on a home equity loan. And there's really kind of two periods to this type of loan. The first period is called your draw period, and then your second period is your repayment period. Now, typically that draw period lasts about 10 years, and you can take what you need as you need it. You're also able to pay back, but you're not required to pay anything back in there. And typically you're not accruing interest over this time. And then your second period is going to be your repayment period, and that is typically an additional 20 years. So home equity line of credit note is typically altogether a 30-year note. note, a 10-year draw period, and a 20-year after that repayment period of whatever you did a draw on. Now, something to note here is this is going to be a second note, typically, like I said, but one of the main ways that they do notes like this is with an adjustable rate mortgage. And so that's something just to be aware of. They don't really do these with fixed rate mortgages that often. As far as we're aware, everything that they're doing with these home equity line of credits are adjustable rate mortgage. So that is something to be aware of. And then your last option is a cash out refinance. Now this is only one note because your old note completely goes away and you get a new note for the amount, and basically you get the cash difference of what you owed and what your new note value is. So let's say that you owed $160. At the end of the day, we're going to pretend that there's no closing costs or anything like that. And let's say at the end of the day you got $180,000. So then your cash that you're going to be able to put in your pocket is going to be the 180 minus the 160, $20,000. Now with all these, you do have to take into account closing costs. I don't want to get too much into those because we're going to talk about that in just a second. So first, before we talk about differences, let's talk about some of these similarities. So like I said at the very beginning, you're typically going to need to, in this transaction, post-transaction, you're going to have to be at 90% loan to value or less. And that's why you've really got to start off at 85% loan to value in order to be able to make this transaction possible. Number two, you can see the money however you see fit. Like I said, recommend you use this for home improvement and debt consolidation, but you are allowed to do whatever you want to do with it. The money is yours at the end of the day. And number three, your home is going to be used as the collateral for these transactions. So that is something just to keep in mind. This is a second note against your house. So if you default, that does put your home possibly in the line of foreclosure or anything like that. So that is something to be aware of whenever you do any type of note or lien or mortgage against your property. Some of the differences is your interest rate is typically going to be lower on a cash out refinance than it is going to be on a home equity line of credit or a home equity loan. So typically, like I said, a home equity loan is fixed rate. You can get a cash out refinance either way with a variable rate or fixed rate. But let's say you went fixed rate on, you looked at the difference in those both with fixed rate. Typically, your interest rate's going to be lower on the cash out refinance than it is on the home equity line home equity loan. And then your HELOC or your home equity line of credit, that's going to have an adjustable rate mortgage that's typically going to be higher than a cash out refinance interest rate as well. Something else to notice on the flip side is typically your closing costs for a cash out refinance are going to be higher. The reason is that there's more than just a new note being created. This is a new note against the full value of your property, and the old note has to be completely removed. So there's more work that has to be done. Typically your closing cost for a cash out refinance is going to be anywhere between 3 and 6% of the amount. And then, home equity line of credits or HELOC loans and home equity loans are going to be on lower typically than that 3% mark. And then lastly, your cash out refi is one big loan, whereas your home equity loan and your HELOC loan are going to be secondary loans on top of whatever note or mortgage you already have in place. Now, with that said, obviously, if you don't owe anything on your house, then they'll be the primary mortgage. But assuming that you still owe something on your home, they will be secondary mortgages. So I want you to remember, though, with any of these options, the way that you get the most success is by working with a quality individual, by working with a quality lender who knows what they're doing, who can understand your unique situation and get you the best rate and terms and amount possible. And the absolute number one way you can do that is by scheduling your free one-on-one call with the My Home Option team. You can go to myhomeoption.com right now, schedule your free one-on-one call. We would be happy to talk with you about you and your situation, what you got going on, what are your goals for this transaction, and then guide you in the right direction. Should you go HELOC? Should you go home equity loan? Should you go cash out refinance? We can answer those questions, point you to the right individual, and set you on the road to success. So make sure you go to myhomeoption.com, and for other videos, make sure you check out our My Home Option channel, and we will see you on the next video. Thanks so much.